If you start paying on a 30-year mortgage with a monthly P&I payment of $1,000, how much more would you need to pay to shorten your mortgage by an extra month? Most people would say $1,000, right? But that's wrong. You would only need to pay $106.80 more. That's right, a payment of $1,106.80 would be equal to 2 months' payments. And if you wanted to reduce the term of your mortgage by a full year, you probably already guessed it wouldn't take a $12,000 payment. No, you would only need to pay $1,318.38 to reduce your 30-year mortgage to a 29-year mortgage. And this is assuming a 30-year fixed-rate mortgage with a balance of $143,017 at 7.5% APR with a monthly P&I payment of $1,000. But this concept applies to any loan, be it a student loan, a car loan, or a signature loan. How do I know this? The magic of the amortization schedule. The source of the word amortization means to kill, but we're talking about not killing you, but the debt you owe. When you first pay a loan, most of your payment goes to reducing interest. That's why banks and also private lenders love making loans. Most of the principal remains unpaid and they make a profit from the interest. Maybe that's why they don't tell borrowers up front about amortization schedules. But personally, I would never pay a loan without having an amortization schedule next to my checkbook or payment method. Since the first loan payment I've made in my life, I've kept an amortization schedule next to my checkbook, and whenever possible, I make 1, 2, or 3 months interest payment on the loan. That's let me pay off my debt years sooner than if I'd otherwise paid on a regular schedule. How do you get an amortization schedule? Hey, I've already mentioned a checkbook, so I'm obviously a dinosaur. But in the old days, I would call the lender and have them send me one. You can probably still do that. Also, you can go online to a site like calculator.net or hucalc.org to print one out. I really like the printed version because it lets you mark the payments you've made, which in itself is rewarding. A few caveats. First, be sure to verify that your loan does not have a prepayment penalty. You can ask your loan servicer to verify this, and if there is a prepayment penalty, to read you the clause in the note. For example, my brother recently took out a car loan with a reduced rate, and that loan prohibited him from prepaying for 6 months, but he could prepay after the 6 months passed. Most mortgage loans and very many loans have no prepayment penalty, but some loans do, so be sure to check in advance. Second, ask the lender how you should designate that the extra payment you're making goes to reducing the principal. In the old days, when you used loan coupons, you could usually just check a box. The same provision may exist now for online payments, but I've never made an online payment, so you should verify for yourself. To be extra safe, and because I'm a bit of a dinosaur, you may just want to mail the payment and a cover letter specifying that the amount you've included goes to reducing principal. And be sure to keep a copy of that letter and your payment check. Finally, after the payment has been processed, follow up to be sure it was applied to the principal. Lenders make more money when you prepay a loan, that is pay payment 1 and 2, and less when you prepay principal. So you want to watch them and be careful the payment is applied properly. Now, where would you get the money for payment to principal? Well, if you're paid bi-weekly, there are 2 months a year when you get 3 paychecks. If you applied each of those paychecks to principal on the new mortgage, by the end of year 1, you could reduce your 30-year mortgage term to 27 years. You could also find funds in pay raises, tax refunds, gifts, or inheritances. That's it. There are no fees and no tricks to prepaying a loan. All you need is an amortization schedule and the desire to get out of debt. So an amortization schedule can help you to kill off your debt more quickly. And believe me, there are few things in life as satisfying as getting out of debt. Good luck on your financial journey, and thank you for watching.